So let's jump right in. We're looking at a huge puzzle that has pretty much everyone scratching their heads. Is the global economy quietly running out of steam, or is it actually in the middle of a massive reboot?
Okay, so here's the deal. On one side, you've got all these traditional economic signals just flashing bright red, basically screaming that a slowdown is coming. But then you look at the financial markets, and they're acting like the party is just getting started. It's a massive contradiction, and we're going to figure out what's going on.
All right, first things first, let's look at the argument for a slowdown. And we have to start with the biggest economy on the planet, the US. Because if you look just beneath the surface, things are starting to get, well, a little weird.
This quote from one of the economists we're looking at really just nails the feeling right now. The US labor market, the thing that's been the bedrock of its strength for so long, is starting to look pretty wobbly. That solid ground is starting to feel a little bit shaky.
And it's not just a vibe. There are some real numbers here that are causing some concern. Hiring has basically slowed to a crawl, almost zero. And wage growth? Yep, that's losing steam too. This all points to one thing. The demand for workers is genuinely cooling off, which is a textbook sign of a weakening economy.
Now, this is where it gets really interesting, because there's a major delay in how this stuff gets reported. We're seeing a big spike in companies announcing job cuts right now. But if you look at history, it takes about 5 months for that to even start showing up in the jobless claims data, and a full 8 months before it actually hits the official unemployment rate. So the trouble could be brewing way before it ever makes the evening news.
And, to make everything even worse, it feels like we're flying blind here. A recent government shutdown created this big data backlog, so we don't even have all the official numbers we're supposed to. Plus, the agencies that collect this data are saying fewer and fewer people are even responding to their surveys. It's gotten so bad, some experts are openly asking if we can even trust the data we do have.
So the big question is, what's the Federal Reserve going to do about all this? Well, some economists are betting that the Fed sees this weakness and is going to have to act way more aggressively than anyone thinks. They're predicting at least 2 more rate cuts by the middle of next year than what the market is even expecting right now, all to prop up this wobbly job market.
Okay, so that's a pretty strong case for a slowdown, right? But that brings us to the other side of this coin, the complete opposite story. Let's talk about the AI lifeline.
I mean, this is the million-dollar question, isn't it? If the job market is stalling and all the data is a mess, why have stock markets, especially tech stocks, been absolutely rocketing higher? There has to be something else going on.
And this quote just puts it all out there. One strategist said it this bluntly: take away the AI boom, and we'd probably be in a recession, or at least pretty close to one. The incredible investment and, let's be honest, the hype around artificial intelligence is the one thing powerful enough to cancel out all the weakness we're seeing everywhere else. And listen, this is not just talk. This is real. Just look at this chart. This is the price of a standard DRAM memory chip. A few months ago, it cost about $5. Today, it's $25. That is an insane vertical move. And it's driven by one thing: the unbelievable demand for memory to power AI. And what's cool is that this whole boom is getting wider. The investment play used to be just about the big, famous tech companies. But now, the smart money is chasing the actual building blocks of AI. We're talking memory chips, yeah, but also tons of copper wiring to connect everything, and even the natural gas you need to power these giant, energy-hungry data centers. And don't think this is just some flash in the pan. Experts are calling this an AI supercycle, and they think it has clear runway until at least the middle of 2026. How do they know? Because you can literally see the pipeline of massive data center projects with crazy names like Stargate and Colossus that are already planned and getting built.
So, we've got these 2 giant opposing forces, a sputtering old economy and a roaring new one. So now let's zoom out and see how this 2-speed world is creating a totally fractured and honestly fascinating global picture.
Okay, check out South Korea. This is wild. It's home to the world's biggest memory chip makers, so you'd think they're just crushing it, right? And they are. But here's the paradox. Their pension system is so underfunded that everyday people are taking their savings and plowing them into US tech stocks for their retirement. So even as their own AI industry is booming, there's this huge river of cash flowing out of the country.
You can see this split even between countries that are right next door to each other. Get this. Australia's central bank says its economy is running hot, in a state of excess demand. Meanwhile, New Zealand's central bank says its economy is operating below capacity, and they actually need to cut rates to get things going again.
I mean, two totally different worlds side by side.
And this kind of split personality is happening everywhere. In Japan, the central bank is just stuck in low gear, keeping the yen weak. Then you have China, where a lot of people think the yuan is about to get much stronger and really stand shoulder to shoulder with the US dollar. And oh yeah, then there's the UK, where all the political drama around the new budget is just creating absolute fireworks in the market.
So, with all this chaos, this two-speed world, how are the pros actually trying to invest? What do you do with all this information? Let's break down the strategies.
Okay, here's a quick rundown of how the experts are thinking. For interest rates, the big bet is on the US, that the Fed is going to have to cut rates more than people think because of that weak labor market. In currencies, it's pretty simple. Stick with the two big pillars, the US dollar and the Chinese yuan. For stocks, it's about being cautious. You stay with the AI theme, for sure, but maybe look for some bargains in other places, like Latin America. And finally, for commodities, the thinking is that industrial stuff like base metals and oil will be in high demand, while a safe bet like gold might actually be a little too expensive right now.
And that really brings us to the final and maybe most important question. Right now, there's no doubt about it. AI is the engine holding up the world. It's creating this bizarre reality where markets can soar while the traditional economy sputters. But it makes you wonder, what happens when the bill for all of this finally comes due? The fate of the entire global economy has never been so tied to the stock market. And you have to ask, what happens if that engine ever starts to slow down?